Today's story is one of the most urgent warnings we've covered this year, and it comes directly from HMRC. Yes, you heard that right. HMRC has confirmed that automatic deductions of £300 or more could soon start hitting pensioners' bank accounts. And this isn't speculation, it isn't rumor, this is a formal change linked to new tax enforcement rules for 2025. For millions of pensioners, that announcement sent shockwaves. Why? Because we're not talking about a minor adjustment or a simple clerical error. We're talking about money being taken directly out of accounts, often without notice, at a time when older people are already grappling with rising energy bills, soaring food prices, and the relentless pressures of the cost of living crisis. Now imagine this: you're a pensioner, living on a fixed monthly income. You've budgeted carefully to cover rent, electricity, council tax, and your weekly grocery shop. Then one morning, you check your bank account and discover £300 has disappeared, taken automatically under HMRC's direct recovery of debt powers. No phone call, no warning letter in advance. Just gone. For someone already on the edge, that deduction could mean a choice between heating and eating, a missed rent payment, or even having to borrow money at high interest just to stay afloat. And so, in today's deep dive, we're going to unpack everything about this major policy shift, why HMRC is targeting pensioners in 2025, which groups are most at risk, how this direct recovery of debt process works, and why banks are central to it. The real-life consequences for older people. What campaigners, charities, and MPs are saying. And most importantly, what you can do right now to protect yourself. So if you're a pensioner, nearing retirement, or supporting an elderly loved one, because this is one of the most important financial updates you will hear this year. Welcome to Pensioners Power, your trusted source for everything you need to know about pensions, retirement planning, and financial wellness. Here, we cover the latest news, expert insights, and essential updates to help you maximize your retirement years. Whether it's understanding pension schemes, making the most of your savings, or staying informed about financial changes, you're in the right place. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss an important update. Now, let's jump right into today's topic. The big question on everyone's mind: why now? According to HMRC, this new deduction system is about fairness. They argue that some pensioners, particularly those with private pensions, savings, or part-time work, are not paying the correct amount of tax under current systems. By recalculating tax liabilities and taking the money directly, HMRC says it ensures everyone contributes their fair share. But here's the problem. Critics argue this is a deeply unfair and overly complex system that effectively punishes older people who did the right thing by saving. In many cases, these deductions relate to tax underpayments from past years. That means pensioners who thought their finances were settled are suddenly being told they owe hundreds of pounds, sometimes more than £300 due to HMRC's recalculations. The government calls it a necessary adjustment. Campaigners call it a stealth tax on the elderly. So what does this deduction actually look like? The £300 figure being widely reported is just an average. Some deductions could be smaller, but for many, they could be far larger. The process works like this. HMRC identifies what they claim is an unpaid tax liability or pension adjustment. They send an instruction directly to your bank. Your bank is legally required to comply. The money is taken from your account automatically. This is called direct recovery of debt, DRD. And here's the most alarming detail. Pensioners often only learn about it after the deduction has already happened. Imagine checking your account for your rent payment and discovering that money has vanished. For older people who live week to week, this isn't just an inconvenience, it's a crisis. Not every pensioner will be affected, but the groups most at risk are surprisingly large. Pensioners with savings over £10,000 in the bank. Anyone combining part-time work with their pension. People drawing from both a state pension and a private/occupational pension. Households claiming benefits where HMRC suspects overpayments. So in short, those who followed government advice to save responsibly for retirement are now being put in the crosshairs. It's a cruel contradiction. Save more, and you risk being targeted. Perhaps the most shocking part of this story is the role of banks. Banks are no longer passive players. Under these new 2025 rules, they have become active partners in enforcing HMRC deductions. This means your bank and institution you trust to safeguard your money can be instructed to hand it over without your consent. Critics say this undermines the entire foundation of trust in the UK banking system. After all, if pensioners cannot rely on their banks to protect their money, what does that say about financial security in this country? And here's the sting: banks are not allowed to refuse. Once HMRC sends the instruction, they must comply. This £300 deduction doesn't exist in isolation. It's part of a much larger series of pension and benefit reforms being rolled out in 2025. These include raising the state pension age, putting additional pressure on retirees, tighter eligibility checks for pension credit and other benefits, stricter property rules for pensioners, where home ownership or savings can reduce entitlements. Campaigners warn this £300 deduction is just the first domino. If it becomes normalized, larger and more frequent deductions could follow £500, £800, or even more in some cases. Let's pause and think about the human impact for a moment. For many pensioners, every pound is already accounted for. Losing £300 suddenly could mean falling behind on council tax or rent, skipping meals to make up the shortfall, having to borrow money from family or payday lenders, experiencing stress, sleepless nights, and a loss of financial independence. Charities warn that pensioners already make up a large proportion of households in fuel poverty and food insecurity. This policy risks pushing thousands more over the edge. Perhaps the most frustrating part of this entire system is the lack of transparency. HMRC communications are often written in complicated tax jargon that many people struggle to understand. Pensioners rarely realize they can challenge deductions, request a repayment plan instead of lump sum recovery, appeal if they believe the deduction is incorrect. But because this information is buried in fine print, most pensioners simply give up, leaving HMRC unchallenged. So what can you do right now to protect yourself from unexpected deductions? Experts suggest several key steps. Check your HMRC tax codes regularly. Incorrect codes are one of the biggest reasons pensioners face unexpected bills. Spread your savings across different accounts. This makes it harder for large lump sums to be taken in one go. Get advice before making withdrawals. Free advisory services can help you understand whether you're at risk. Challenge deductions you believe are unfair. Don't assume HMRC is always correct. You have rights. Knowledge is your first line of defense. It's not just pensioners raising the alarm. Campaign groups, charities, and even some MPs are calling this policy out. They're demanding an independent review of HMRC's deduction powers, exemptions for pensioners from the DRD system, a minimum protection threshold so savings can't fall below a safe level, clearer, simpler communication from HMRC about people's rights. The fight is just beginning. But the question is, will the government listen or push ahead regardless? If this £300 deduction becomes standard, experts warn it could open the floodgates for even more deductions in future. Think about it. If HMRC can recover tax this way, What's stopping other agencies from doing the same for council tax arrears, energy debts, or benefit overpayments? This could lead to a future where pensioners have less and less control over their own money, with deductions happening automatically and without meaningful oversight. Thank you for watching Pensioners Power. If you found this video helpful, be sure to give it a thumbs up and share it with others. Stay informed, stay engaged, and we'll see you in the next video with more insights on the issues that affect the UK. Take care, and don't forget to subscribe to my channel for all the latest updates.